it is a tough time. We've seen quite a bit of volatility, and we hopefully are starting to see some solution coming through for the Eurozone crisis. And in the midst of this all, JSE All Share is still very much stuck in a very tight trading range. We've got inflation ticking up in the country. We've got a much weaker local currency than we had about a month ago. Is it time to start looking at your portfolio and reweighting asset allocation, or would you be sticking to the same strategy you had about a month ago?
I think about a month ago I actually started changing it. It is roughly about that long ago, and upping the equity weighting from 40 to 50%, and lowering the physical gold weighting, I think, from 10 to about 7.5. But having said that, I don't think it's a major shift. It's more of a tactical play, and I'll be taking it to the top end of what I think is a good asset allocation that is appropriate for my clients. And that would be a maximum of 50% in equities.
Okay, before we get into exactly the numbers that you're looking at with regards to asset allocation, I've actually been speaking to a few investors this week, and some of the view that you should be taking a passive approach to the market as opposed to an active approach. Would you agree with this, and do you think that this notion is actually more swayed towards the equity market as opposed to overall allocation of various asset classes?
I think the active versus passive argument really just applies more to the equity portion of one's portfolio, and I think people have way too much emphasis on that. What's much more important is the asset allocation. I think this active passive debate it's a diversion, and I really don't think it actually adds much value to a portfolio at all.
Kimon, when you look at portfolios, we know that there are equity-only portfolios. We know that portfolios such as yours has inflation-linked bonds, equities, bonds, and gold and cash as well. Do you think that many people out there are starting to see a very different picture, that we should be very diversified to mitigate against any kind of risk factor hitting one specific asset class?
Well, it's been a long time since I've been advocating good asset allocation. And I think the equity-only portfolios that you speak of are really just the equity portion of a bigger fund, and I think that's important to note. What we tend to find in South Africa, sadly, is that the asset allocation there's a one-size-fits-all approach to all the funds, and I strongly disagree with that. I don't think the asset allocation is appropriate, and I don't think a lot of thought goes into it, or not enough. And I'm generalizing, of course, but I think a lot more work needs to be done in that area, because I think that's really why people are in the mess that they're in. I'll give you an example. 10 years ago in the UK, Boots Pharmaceuticals looked at their assets and looked at their liabilities going forward, and they put 100% of their portfolio into UK government bonds. Totally appropriate for that fund. In hindsight, it was a perfect move, because equity markets haven't done all that much and bond markets have rallied over that period. But it's not about picking the best asset class. It's about diversifying your portfolio sufficiently well that in times of crisis you don't have to worry about it. And what I'd like to hear a lot more of, it's people talking about capital preservation, because suddenly with the markets not doing what everyone anticipated them to do, or particularly the equity market doing so poorly, and other asset classes doing much better, everyone's worried now about the capital, and hence the flight out of equities. So I think the weightings towards equities have been traditionally too high and not appropriate for individual portfolios.
When you look at your allocation within the equity market, you said that about a month ago you shifted from around 40% weighting in equities to around 50%. Why a month ago, at a time where a lot of people are saying that we possibly could see another blowout on the equity front? Tell us about this move and why it actually is very strategic at a time where there's still so much uncertainty with regards to this asset class.
Well, for one, I think that a large part of the fear had driven the market to a low. We saw a mass exodus out of countries like ourselves, international investors pulling money out of Australia, pulling money out of Brazil, South Africa, China and India, and repatriating that money back to Europe. There is a bit of a cash shortage there with all the debt problems they have, and repatriating money back to the US. So in light of that, and the fact that we've had really all the bad news that one could throw at a market, it's a slightly contrarian approach, and there is a cyclicality to the equity market in particular this time of year. And I thought I'd take the approach where there was relative value around, and to up the equity weightings to that 50%, because I think there were some great buying opportunities in general.
Are you looking at specific stocks at this point in time, Kimon? And obviously, if you're going to be upping your equity weighting, then you obviously believe that markets should be rallying. Of course, we're sitting at 31,100 points on the JSE All Share. What kind of rally are you expecting? Is it a stock picking market? How are you finding value?
I think that there should always be a stock picking market. I don't think one should buy the market willy-nilly. It tends to happen. I like the liquid stocks, so that kind of restricts our weightings to probably the top 60 or 80 stocks in the country, which would be fairly representative of the index largely. So, but within that, I still think you have to be a stock picker. As you know, I've avoided banks for a couple of years now, and I think it's time to actually put one's toe in the water and invest in some of the banks locally. I do think they're going to rise with the rest of the tide, and I think there may be one or two buying opportunities there. And as I mentioned earlier, the kind of rally that I'm looking for could extend into January, February, but I'd be conservative and look for between 10 and 15% rally in the equity market.
And once we see that rally, would that mean that you'd start selling at that level then?
I would anticipate that, yes. I think when one invests in any particular stock or any particular instrument, one should have a strategy, an exit strategy. And again, I think that's often what is lacking in portfolios. When it reaches your target, you know, some people will sometimes hope it gets the better of common sense, and we don't exit. But what I always do is reevaluate my position virtually daily. And when it does reach my target, I have another hard look at it, and there's got to be really compelling reasons for me to stick with it and not exit.
Bonds, you obviously favor bonds, inflation-linked bonds accounting for 20% of your portfolio. Bonds as a whole, around 15%. That's quite a large weighting. Give us the thinking behind that.
Well, first of all, I think one should always have in an investment in all the asset classes, and what is appropriate for my portfolios is at least 10 to 15% in physical bonds. But within that, I think the area that I'd be concentrating on is the shorter end of the yield curve. So I'd be looking at bonds perhaps up to 10 years in duration, and I'd be happy with those, because I think with the prospects possibly of inflation rearing its head, we may see the long end of the yield curve rise. It may not happen, but I'm far more comfortable in the 0 to 10-year area in bonds. So I think one should always have that as an investment. And inflation-linked bonds, I think, are one of the instruments that really help you achieve what you would like to achieve out of a portfolio. Because at the end of the day, why do we invest in anything? It's ultimately to beat inflation over time. So it is an important cornerstone for any portfolio, I believe, and the weighting is still pretty high at 20%, and I'm very comfortable with that.
I know you're quite a fan of gold, and you said that you've taken your gold exposure from 10% to 7.5%. Why?
Yep. I think, again, it's a tactical thing. The position that I'm taking is that gold I like as a currency diversifier, first of all. And again, it's physical gold. I'm not. There are some compelling reasons to be in some of the gold stocks, but I'm far happier with the physical holding. Again, what it also does, in a way, it is a rand hedge, and as the rand's blown out, the rand value of the gold has risen. Again, it's a good diversifier, and it's ultimately, in my opinion, the best currency in the world. So you can't print any more of it. You know, as long as there's paper and ink, governments will be printing and devaluing their currencies that way. So what it does do, again, is shore up my store of wealth in a portfolio, and I'm pretty adamant that one should have at least 5% and up to 10% in physical
So
gold.
Kimon, I mean, the fact that you've actually gone down a bit on your gold exposure, at what point would you start increasing it? Again, we haven't gotten rid of the worries and troubles in the Eurozone, and we could be pricing in a possible default also. At what level would you start, at what point would you start bringing that number higher, to close to the 10%, or even breaching that level?
I'm often guided by technical levels, both in stocks or across the board, really, in all the asset classes. And some are more technically driven than others. And as a commodity, I do know that many of the investors, hedge funds, etc., are looking at the 1600 level. If it should breach that, then I'd anticipate possibly 1,200 on the gold price. But until such time, I'm going to maintain the 7.5% holding. If that should be breached, I'll probably lower to 5 and look to re-enter lower.
When you say cash, I know that you've got exposure of 7.5%. Does that include all currencies, or are you just holding rands right now, or have you diversified into dollar and euro?
No, that portfolio is entirely a local portfolio. I'm not a big fan, as you know, of dollars, euros, or pounds. So I'm happy not to have the exposure there. I think if one looks at a totally international portfolio, and one is allowed to invest up to 20% offshore, then I'd be looking at the currency exposure on a regional basis. So instead of actually going out and physically buying either sterling or euros or dollars, I'd be looking for assets within those countries that I'd be paying in those currencies anyway. So I'd get my exposure that way.
Yeah.
But as it stands right now, I think I'm happy to have a totally South African-based portfolio with my currency hedge being my gold.
So Kimon, if you're expecting a rally on the 10 to 15% rally until Feb next year, does that mean that you see things getting sorted out in the Eurozone, that US unemployment is going to start recovering and the property market is going to look better, and that China won't have a hard landing? Can I assume that?
No. I think what
okay, well, I'm just saying, because you're increasing your exposure to equity, so I'm assuming some kind of good news is going to filter through and the bad news will be done away with.
I think largely people will realize that not all the bad news that they were anticipating will actually transpire. So ultimately, I think we're going to have a relief rally of sorts where the world actually hasn't fallen apart and the sky hasn't fallen on anyone's head. I think there's still going to be troubles. I think there's still going to be volatility largely. But when I look at South Africa, I think we're not isolated against those moves because we certainly do feel the effects of what happens internationally, but to a lesser degree. So I do anticipate a rally in the international markets and thereby also a rally in our own.